Estate Board of Greater Vancouver Introduction to Listing and Selling Commercial Investment Properties. Introduction. Objectives. This course introduces real estate practitioners to the fundamental knowledge and working mechanics of listing and selling commercial investment properties. It provides learners with a hands-on approach to the opportunities of listing and selling commercial investment properties. Learners will walk away from the class with real-life experience in analyzing, listing, and selling commercial investment properties. At the end of the class, learners should be able to 1. Use the right agreement form for different scenarios of agency representation and listing fee agreement in commercial real estate. 2. Identify major differences between working with sellers when listing commercial investment properties versus residential properties. 3. Identify major differences between working with buyers when selling commercial investment properties versus residential properties. 4. Use annual property operating data, APOD, net operating income, NOI, and cap rate to price commercial investment properties. 5. Using a case study, analyze opportunities for commercial investment properties as a listing or selling agent. Basic concepts of commercial investment properties. What is commercial real estate, CRE? Any multifamily residential, office, industrial, or retail property that can be bought or sold in a real estate market, NAR. Any non-residential property used for commercial profit-making purposes. Any property owned to produce income. General characteristics of investments. Liquidity. Ability to convert an asset to cash quickly without loss of much value. Marketability. Ability to convert asset into cash quickly at any price. Leverage. Use of borrowed funds to finance an investment. Management. Cost of monitoring an investment. Asset management. Monitoring of the investment's financial performance. Property management. Monitoring the overall day-to-day operation of the property. Tax efficiency. Ability to minimize tax liability. Return on investment, ROI. Measurement used to evaluate the efficiency of an investment, a gauge of its profitability. Risk. Possibility of losing principal and/or potential income. Benefits of commercial real estate investments. Cash flow. Capital appreciation. Equity build up from mortgage paydown. Tax efficiency in taxable capital gain and tax deferral in capital cost allowance. Own occupancy use. Brick versus click. Introduction to listing and selling commercial investment properties, your agency relationship with consumers. In this section, the emphasis is not on explaining the duties and responsibilities realtors owe to consumers, but on realtors choosing the right listing fee agreements under different combinations of agency relationships and payor situations so as to get paid. There are 3 agency relationships you can have with consumers. 1. Designated agency. 2. Limited dual agency. 3. Customer relationship. Hence, you can either 1. Represent seller only, or 2. Represent buyer only, or 3. Represent both buyer and seller under limited dual agency agreement. Or 4. Do not represent either buyer or seller. There are also 4 types of payor scenarios. 1. Seller pays you, buyer does not pay you. 2. Buyer pays you, seller does not pay you. 3. Both buyer and seller pay you. 4. Neither pay you. there should be a different listing fee agreement that corresponds to different payor scenarios under different agency representation. BCREA provides forms that apply to these scenarios, and in the next section we will explore the following forms, which can be found in the appendices and through web forms online. BCREA listing contract fee agreement forms as of January 2016. Appendix A. Alright, and here's a list of all the different forms. So there's a multiple listing contract. B, Appendix B, exclusive listing contract. C, limited dual agency agreement. D, fee agreement, seller pays, buyer represented, seller not represented. E, fee agreement, seller pays. F, buyer's agency exclusive contract. G, fee agreement, buyer pays. H, fee agreement, buyer pays. Who's going to pay your commission? Seller pays. You see there's a little box at the top here. It says seller pays. There's an arrow going down here. It says represent seller. So there's either a no or a yes. The no here goes over here. It says represent buyer, no or yes. If you say no, it says fee agreement, seller pays, buyer and seller not represented. All right, let's go back here. Pretty intricate. So represent seller, yes. So you have a choice between represent the buyer, yes or no. If it's no, multiple listing contract, Appendix A, or exclusive listing contract, Appendix B. If it's yes, there's a multiple listing contract, A, exclusive listing contract, B, and limited dual agency, C. If we go back here, seller pays, represent seller, no, represent buyer. If we say yes, then it's fee agreement, seller pays, buyer represented, seller not represented. Hope that makes sense. So, who's going to pay your commission? Buyer pays. So, buyer pays. So, you represent the buyer. If no, you represent seller. If no again, there's a fee agreement, buyer pays, buyer and seller not represented, Appendix H. If you say yes to represent the seller, fee agreement, buyer pays, seller represented, buyer not represented, Appendix G. So if you go down here again, buyer pays, represent buyer, yes. So we say represent seller. If it's a no, buyer's agency exclusive contract, Appendix F, or fee agreement, buyer pays, buyer represented, seller not represented. If we say yes to represent the seller, we say fee agreement, buyer pays, buyer and seller represented. So use the right form. Scenario 1. You sold John and Hillary their home 1 year ago. John is a partner in a litigation law firm, while Hillary is the chief accountant of a public agency. They have just inherited a portfolio of commercial investment properties that is worth $30 million scattered around the Lower Mainland. Today you receive a call from Hillary asking if you want to meet her and John to discuss about listing one of their apartment buildings in the Metrotown area. 1.1. Who do you represent and who pays you in this listing contract situation? So who do you think it is? Answer the question. 1.1. Which listing contracts or agreement forms should be included in your listing package? During the meeting, John talks about not wanting every realtor in the province to know that the property is for sale. So 1-2, which listing contracts or agreement forms should you provide to John and Hillary instead, since he wants to keep it secret? And then we have 1-2.1, who do you represent and who pays you in this listing contract situation? 1-3, what are the pros and cons of using the exclusive listing contract, ELS, versus the multiple listing contract, MLS? exclusive listing contract, market exposure. So say something about that. Listing agent's control on the listing for the exclusive. Confidentiality. What about that for the exclusive? Rules and regulations on the listing. How about that for exclusive? So how about for the multiple listing contract? Market exposure, listing agents, control on the listing, confidentiality, rules and regulations on the listing. 1-4, if a buyer also wants you to represent him, what agreement form do you need the buyer and John and Hillary to sign before presenting the offer? All right. Scenario 2. You sold Peter and Mary their home a year ago. Peter is a doctor and Mary is a dentist. They have bought a portfolio of commercial investment properties that is worth $30 million scattered around the Lower Mainland in the past 2 years. Today, you receive a call from Mary telling you that they want to buy an apartment building in the Metrotown area, and they have located the building themselves already. Peter and Mary like the building so much that they want to put an offer on right away. You immediately prepare a contract of purchase and sale for the property. Peter and Mary want you to be their agent, and they expect this seller will pay you the commission. 2-1, who do you represent, and who pays you in this situation? 2-1.1, which listing contracts or agreement forms should you provide to the owner of the building and to Peter and Mary to secure your commission? Before the offer presentation, the owner of the property, Michael, tells you that he is not prepared to pay your commission. He also does not need any real estate agent to represent him. You have to go to Peter and Mary to get paid. 2-2, who do you represent and who pays you in this situation? 2-2.1, what listing contracts or agreement forms should you provide to Peter and Mary if they agree to pay your commission instead? Scenario 3. You bought Peter and Mary their home a year ago. Peter is a doctor and Mary is a dentist. They have bought a portfolio of commercial investment properties that is worth $30 million scattered around the Lower Mainland in the past 2 years. Today you receive a call from Mary telling you that they want to buy an apartment building in the Metrotown area in the next 6 months. Peter and Mary want you to be their exclusive agent to find property, and they are prepared to pay you commission at 2% of the purchase price. If you are offered the cooperating agent's commission of other agents' listing that is less than 2%, they agree to pay you the shortfall. 3-1, who do you represent and who pays you in this situation? 3-1.1, what listing contracts or agreement forms should you provide to Peter and Mary? Scenario 4. You are a very successful and well-known realtor in your area. One day, you have an unsolicited call from the owner of a commercial investment property called Michael. He is a very sophisticated investor, and he tells you that his property is ready for sale. He indicates to you that he knows his stuff and he does not think a realtor will represent his interests. Just bring the offer and I will pay you. You immediately search your database and locate a prospect, Paul, who you met a long time ago. However, Paul is notorious in the industry as being very untrustworthy and tends to sue everybody on his way. The last thing you want to do is to represent him. 4-1, who do you represent and who pays you in this situation? 4-1.1, what listing contracts or agreement forms should you provide to Michael and Paul before bringing Paul's offer to Michael? Paul's offer price is so low that Michael tells you that you have to ask the buyer to pay your commission to make the deal work. And Paul agrees to pay you the commission. 4-2, who do you represent and who pays you in this situation? 4-2.1, what listing contracts or agreement forms should you provide to Michael and Paul instead? Disclosure of remuneration. Disclosing remuneration, what to discuss, to whom, and why. You, as a real estate licensee, have an obligation to disclose to your clients any remuneration that your brokerage will receive in relation to real estate services provided to the parties involved in the real estate transaction. The council rules require that licensees disclose all remuneration they anticipate receiving that is not paid directly by the client. See Appendix 1 for disclosure of remuneration trading services form. Scenario 5-1. Designated agent acts only for buyer ABC Venture Limited. XYZ Capital Inc. seller is represented by a licensee engaged by KYC Realty Limited listing brokerage. It has a listing agreement to pay a total commission of $100,000 with $40,000 to be paid to the cooperating brokerage. You are the designated agent for ABC Venture Limited buyer who is going to make an offer on the property of XYZ Capital Inc. Activity 5-1, fill in Part B of the disclosure of remuneration form. I, put your name, am licensed under the Real Estate Services Act, and I disclose to you that my related brokerage, put in the name, anticipates receiving a commission of, put the money there, from, put the name there, with respect to real estate services provided to you or on your behalf in relation to the subject real estate. Scenario 5-2. Designated agent acts as limited dual agent. You are represented XYZ Capital Inc. seller in listing and selling a property. XYZ Capital Inc. has agreed to pay a total commission of $100,000 with $40,000 to be paid to the cooperating brokerage. You are the designated agent for ABC Venture Limited buyer who is going to make an offer on the property of XYZ Capital Inc. In this transaction, you are the designated agent of both the seller and the buyer. With the consent of the seller and the buyer, you are acting as a limited dual agent for both parties. Activity 5-2, fill in Part B of the disclosure of remuneration form. I, your name, am licensed under the Real Estate Services Act, and I disclose to you that my related brokerage, put in your brokerage, anticipates receiving a commission of, put in the price, from, put in that person's name, with respect to real estate services provided to you or on your behalf in relation to the subject real estate. Scenario 5-3. Different designated agents from the same brokerage represent buyer and seller individually. A designated agent from your brokerage is representing XYZ Capital Inc. seller in listing and selling a property. They have agreed to pay a total commission of $100,000 with $40,000 to be paid to the cooperating brokerage. You are the designated agent for ABC Venture Limited, buyer, who is going to make an offer on the property of XYZ Capital Inc. Activity 5-3, fill in the Part B of the disclosure of remuneration form. I, name, am licensed under the Real Estate Services Act, and I disclose to you that my related brokerage, put in the name, anticipates receiving a commission of, put the money in, from, put the name in, with respect to real estate services provided to you or on your behalf in relation to the subject real estate. Working with sellers. Here's a graph. On the left-hand side here, what is this here? All right. It says prospecting on top. Going down, you get the appointment. No, you got to go to the left. If it's yes, you go to the right here. You go down. This is called back to prospecting. Pre-listing interview. Go down. Research and analysis. Listing appointment. Get the listing. Yes or no. Wow. We have another one here on the right-hand side. Oh yeah, this is a continuation. Collect, verify, analyze the data. Prepare, revise marketing plan. Marketing process. Obtain an accepted CPS, contract of purchase and sale, yes or no. If it's yes, due diligence process, subject removed, yes or no. And we keep going. In this section, key differences between working with sellers of residential real estate property and working with sellers of commercial real estate investment properties will be highlighted and discussed. Prospecting. So we have residential on the left and commercial on the right. So residential, we have expired, canceled listings. Commercial, the same. Residential says attend local community events. Commercial says attend commercial forums. Residential is join social clubs. Commercial is join investment clubs. Residential is snail mail email list. Commercial's the same. Residential says build up database, and commercial says the same. Residential says sphere of influence, repeat business and referrals. Commercial says residential colleague referrals. Residential has open houses. Commercial, no opens. Get appointment. Residential says daytime, evenings, weekends. And commercial says most likely during Monday to Friday 9 to 5 office hours. Residential at your office or client's home. Commercial's most likely at prospect's office. Residential says cold, warm calling anytime. And commercial is no cold, warm calling after office hours. Pre-listing interview. Residential can obtain listing in the first meeting. Commercial, do not expect to get the listing in the first meeting. Residential, get to know the prospect better and vice versa. Commercial, get to know the prospect better and vice versa. Yes, it's the same. Residential says gather preliminary info regarding the property and seller's motivation to sell. Commercial, gather preliminary information re the property and seller's motivation to sell. Yes, it's the same. Research and analysis, research on property, research on market, and research on the seller. So, research on the property. Realtors own resources. So for residential, you have the Paragon MLS Residential. Commercial, you have Paragon MLS Commercial, which I believe is still in its infancy. We've got the Commercial Broadcast Email Service and Commercial Edge. So the REBGV's Commercial Broadcast Email Service access a network of more than 10,000 commercial realtors across British Columbia. This service provides commercial members the ability to sell and receive haves and wants email messages related to commercial real estate, as well as exchange professional knowledge questions related to commercial real estate. For more information, visit commercial services on rebgv.ca. Property listing history on Paragon MLS Commercial. Property listing history on Commercial Edge. And that's commercialedge.ca. Commercial Edge gives subscribers access to one of the most comprehensive, accurate, and continuously updated historical sales databases. Commercial Edge is convenient. Subscribers are connected with high-quality commercial data without having to make numerous phone calls or research endless tax documents or market reports. Our database has thousands of sales comparables in numerous property types, including retail, commercial, industrial, multifamily, and vacant land. Research on the property government resources. Residential has CMHC, commercial the same. Residential has BC Assessment, or they call it eValue, right? Commercial the same, and residential has Cities GIS. Van Map for Vancouver. In Surrey here, it's Cosmos. Commercial has the same. Residential has BC Online, My LTSA, and commercial has BC Online, My LTSA. But commercial has something residential doesn't have. It is the Federal Incorporated Company Search. CMHC, Canada Mortgage and Housing Corporation. Here's the website. BC Assessment, the city's GIS. Check, each city will have their own. BC Online, Property Title Search on My LTSA, and Federal Incorporated Company Search. Take a note of these websites. And we have research on properties, third-party resources. Commercial, we have RealNet, CoStar, LoopNet, Altus Group Analytics. Commercial brokerages like CBRE, Colliers, or they say Colliers, right? Avison Young, Cushman & Wakefield. Search engines like Google. So, going down, it says RealNet, realnet.ca. RealNet delivers detailed research, analyses, and insights on commercial real estate and residential development markets in Canada. Listing services, LoopNet TM, loopnet.com. This is an online resource for tenants and investors when searching commercial real estate listings and other resources for commercial real estate. Listing services, CoStar TM. This is a comprehensive database of commercial real estate information. Altus Group Analytics, altusgroup.com. This is one of the leading providers of independent advisory services, software, and data solutions to the global commercial real estate industry. The 5 core practices: research, valuation and advisory, Argus software, property tax consulting, cost consulting and property management, and geomatics, embody and reflect decades of experience, a broad range of expertise, and leading-edge technology. Altus Group Analytics empower their clients to analyze, gain insight, and recognize value on their real estate investments. Commercial brokerages like CBRE, Colliers, Avison Young, Cushman, and Wakefield. And here are the websites, search engines like Google. And I believe there have been some shakeups in the commercial real estate industry. So Google, what are some of the latest mergers and movements? Research on market. Residential, you have Paragon MLS Residential, You have for commercial, Paragon MLS Commercial. Residential has the REBGV Stats Center tool, and commercial doesn't have that, but it has CMHC Market Condition Vacancy Rate, cap rate from Colliers and Altus Group reports, and we have a comparable cap rate from RealNet. Research on seller. Residential, know your client. Commercial, same. Seller's information on my LTSA title search for and commercial has same. Residential has seller's property portfolio from my LTSA. Commercial 2. Commercial also has corporate seller's directorship from BC, online or federal incorporated company search. Listing appointment. Present listing agreement with preliminary marketing plan. Multiple listing contract versus exclusive listing contract. Prepare to and revise marketing plan. Presents sample marketing plan. Traditional versus non-traditional marketing method and social media marketing. Marketing process. Well, residential has Paragon MLS Residential. Commercial has Paragon MLS Commercial. Residential and commercial both have email campaigns, brochures. Residential has Real Estate Weekly, etc. Commercial has Western Investor, also LoopNet and RealNet. Obtain an accepted contract, only half the work done. Contract is most likely with conditions. Due diligence, cooperate with buyer or buyer agent. All sorts of inquiries regarding the property. Environmental issues, compliance with government regulations, non-conforming use. Removing subjects. What's the difference between residential and commercial? Well, residential generally one subject removal date for all subjects. Commercial has multiple subject removal dates that may span for a few months. Residential has increase in deposit upon subject removal date. Commercial has increase in deposit upon each subject removal date. And commercial also has seller may demand non-refundable deposit. Working with buyers. So here's a graph. Prospecting. Get the appointment, yes or no? Yes. Qualifying interview. Research and analysis. Present property information. Find properties of interest, yes or no. Go up here. Preview selected properties. Find suitable property, yes or no. Write the CPS. Is CPS accepted? Yes. Due diligence process, subject removal. In this section, key differences between working with buyers or residential real estate property residential real estate property and working with buyers of commercial real estate investment properties will be highlighted and discussed. Prospecting. Additional ways to prospect for buyers for both residential and commercial include sold listings and past clients. Get appointment. Residential, it's all over the place. It's daytime, evenings, weekends. Commercial is most likely during office hours. Residential at your office or client's home. Commercial is most likely at prospect's office. Residential is cold, warm calling anytime. Commercial has no cold or warm calling after office hours. Qualifying interview. Residential, get to know the prospect better and vice versa. Commercial, same. Residentials gather preliminary info regarding the property and seller's motivation to sell. Commercial, same. Residential is determine financial resources, i.e., are they ready, willing, and able to purchase? Commercial's the same. Residential determine if the prospect's needs exist in the market. Commercial is the same. Research and analysis. Research on the properties that the buyer is interested in, the market, and the buyer. Research on the property. Realtor's own resources. Residential, you've got Paragon MLS Residential. Commercial, you've got Paragon MLS Commercial. Residential, you've got the REBGV Stat Center. Commercial has a commercial broadcast email service and commercial edge. Research on property, government resources. Residential and commercial both have CMHC, BC Assessment, the city's GIS or Cosmos, the BC Online My LTSA, but commercial has one. It's got the Federal Incorporated Company Search. And here are all of the websites for all of these. You can Google them. Research on the property. Third-party resources. So we've got commercial, RealNet, CoStar, LoopNet, Altus Group Analytics, commercial brokerages like CBRE, Colliers, Avison Young, Cushman & Wakefield, search engines like Google. Here are all the websites for those. Research on market. We've got residential, we've got the Paragon for residential, commercial has the Paragon for commercial, residential has the REBGV Stat Center, commercial has the CMHC, market condition vacancy rate, cap rate from Colliers and Altus Group reports, comparable cap rate from RealNet. Research on the buyer, residential and commercial know your client, buyer's information on My LTSA title search, commercial same. Commercial has buyer's property portfolio from My LTSA, corporate buyer's directorship from BC Online or Federal Incorporated Company Search, and CANLII, Canadian Legal Information Institute. Present property information. Meet the client to present listings. Now, you can use automatic and email notification from the Paragon MLS. Preview selected properties. Most of the time, prospect will drive to the property and meet you outside. Maximum of 5 properties to show. Attention, property managers, be a friend to the buyer and buyer agent. Write the offer. Use the contract you are familiar with. There is no standard clauses in commercial real estate contract. Every transaction is different. Is contract of purchase and sale accepted? Only half of the work is done. Contract most likely with subject clauses. Due diligence. Investors of income properties do not buy real estate. They buy a bundle of contracts secured by tenant covenants. The purpose of due diligence is to determine risk, evaluate value, provide negotiating strength, assess potential upside opportunities. Typical areas of due diligence in residential real estate, we have building condition report, title search, appraisal, strata document review, neighborhood review, amenities and institutions, environmental and well water and septic system rural. Typical areas of due diligence in commercial real estate. Ownership, 16 items. Construction, 9 items. Environmental, 19. Insurance, 8. Management, 4. Employment, 8. Leasing, 17 items. Operation and development. Corporate structure. Accounting and financial. Anyway, they got a whole mess of items, each one. You can see it here. Accounting and financial. Intellectual property, licenses and regulatory, financing, tax and litigation. Purchaser's due diligence team, lawyers, appraiser, environmental assessment company, construction assessment company, accountants, financial analysts, lease abstractors, financial backers, equity and debt. Removing subjects. Residential, you have generally one subject removal date for all subjects. Commercial, you have multiple subject removal dates that may span for a few months. Residential has increase in deposit upon subject removal date. Commercial has increase in deposit upon each subject removal date. Commercial also has non-refundable deposit. Net operating income. This is from Pricing Commercial Investment Properties. Net operating income, NOI, is the annual income generated by an income-producing property after receiving all income from operations and then deducting all expenses required to operate the properties. So here is the formula for net operating income, NOI. So we have a potential rental income, PRI, plus other income affected by vacancy, minus the vacancy and credit losses. This will equal the effective rental income, the ERI, plus other income unaffected by vacancy equals the gross operating income. And that is minus the operating expenses. This comes out to the, or equals the net operating income, the NOI. NOI identifies the ability of a property to produce an income stream from its operation. NOI is unique to the property and is unaffected by the financing and tax status of the owner. Items excluded from operating expenses: debt service, that's the interest and principal payment, depreciation expense, capital expenditure like major repairs and replacement, income tax expenses of the property owner, and replacement reserves. The following example illustrates the concept. Potential rental income per month: $10,000. The vacancy and credit loss, 3%. Operating expenses, we have the real estate taxes, $10,000. Insurance, $2,400. Repairs and maintenance, $2,000. And hydro and utilities, $2,000. NOI is calculated as potential rental income, $120,000, plus other income affected by vacancy, 0, minus vacancy and credit losses, $3,600. That equals the effective rental income of $116,400, plus other income unaffected by vacancy, 0, equals the gross operating income, $116,400, minus the operating expenses, $16,400. That's equal to the net operating income of $100,000. And that's the end of this section. We've got scenario 6. You sold John and Hillary their home 1 year ago. John is a partner in a litigation law firm, while Hillary is the chief accountant of a public agency. They have inherited a portfolio of commercial investment properties that is worth $30 million scattered around the Lower Mainland in the past 2 years. Today, you receive a call from Hillary asking if you want to meet her and John to talk about listing one of their apartment buildings in the Metrotown area. Before the meeting, Hillary sends you the statement of loss and deficit from last year. So here we have a statement of loss and deficit for the year ended December 31st, 2015. Revenue, rental income. In 2015, that was $414,670, and that is also the total revenue. We go down to the expenses. Let me see if I can increase this here so you can see it better. So we have the bank charges and interest, $1,023. We have the business license, $1,449. Depreciation is $127,833. Insurance, $10,945. Legal and accounting, $2,509. Loan interest, $158,624. Management fee, $8,763. Miscellaneous, $903. Office supplies, 0. Property taxes, $26,238. Repairs and maintenance, $44,260. We have the salaries and benefits, $26,441. Telephone, $919. Utilities, $70,813. Waste removal, $7,264. WCB expenses, 253, and we have the total expenses comes out to 488,237. Now we gotta decrease this a bit. So 6-1, based on the information in the statement of loss and deficit, fill in the necessary fields on the annual property operating data APOD below for the property Appendix L, page 101. So this is kind of like homework. So if you take a look at the sheet here, we've got the annual property operating data. So that's what we call it, APOD. Property name, plug it in. Location, type of property, size of property, square feet, and also units. Purpose of analysis. Then we go down here to the assessed appraised values of the land. Over here, improvements, Class 1, Class 8, and Class 17, all improvements, and then the total. And adjust this basis as of, and put that here. On the right-hand column, it says purchase price, plus acquisition costs, plus loan fees, less mortgages, and then equals the initial investment. So here we have a balance for first and second. All these have a first and second line, horizontal line. So we have the balance for first and second, the periodic payment, the payments per year, the interest, the amortization period, and the loan term. So take a look at this. All figures are annual. So we have number 1, potential rental income. All right, the dollars per square foot or dollars per unit, and then we have the percentage of the GOI. We have comments and footnote section. So 2 here we have plus the other income affected by vacancy. 3, less vacancy and CR losses. That's credit? Okay. All right. Then we have 4, the effective rental income. 5, plus other income not affected by vacancy. 6, gross operating income, operating expenses. 7, we've got the real estate taxes. 8, bank charges and interest. 9, property insurance. 10, off-site management. 11, payroll. 12, expenses and benefits. 13, taxes, workers' compensation. 14, we have repairs and maintenance, utilities. 15, we have management fee. 16, telephone. 17, waste removal. 18 is blank. 19, accounting and legal. 20, permits, licenses and permits. 21, advertising. 22, supplies. 23, miscellaneous contract services from lines 23 to 28. Then we have the total operating expenses. 29. 30 is net operating income. 31, less annual debt service. 32, less funded resources. 33, less leasing commissions. 34, less capital additions. And 35, cash flow before taxes. And this is, it says here, authorized by Gary G. Tharp, CCIM, copyright 2001 by CCIM Institute. So this is the Training Institute. The statements and figures herein, while not guaranteed, are secured from sources we believe authoritative, prepared by, put the name, prepared for, put the name. So, 6-2, what is the operating expense of the property? 6-3, what is the net operating income of the property, assuming you have 0% vacancy and bad debt? Capitalization rate, cap rate. This figure measures the income generating performance of a property related to the purchase price. It is expressed as a number, for example, 8 times. It basically measures the payback period of the net operating income against the purchase price. So take a look over here. It says a cap rate equals the NOI, the net operating income, over the purchase price. So R is rate, e.g., that is the cap rate. I is the income, for example, that is the net operating income, and V is the value, the purchase price here in this diagram. So we have the rate is equal to the income over the value, and this is the value equals the income over the rate, the cap rate, and then we have income here equals the value times the rate. Turning the formula around, we can calculate the purchase price market price from cap rate as purchase price slash market price equals the net operating income NOI over the cap rate. Turning the formula further around, we can calculate the NOI from cap rate. Net operating income NOI is equal to the purchase price over the market price times the cap rate. So 6-4, based on the information of the property in scenario 6, what is the cap rate of the property if the market price is $7,280,000? 6-5, based on the information of the property in scenario 6, what is the market price of the property when cap rate is 3.3%? 6-6, if the buyer thinks that he or she can reduce the operating expense by 10%, what is the market price of the property when cap rate remains at 3.3%? 6-7, what is the market price of the property when comparable cap rate drops 10% itself to 3.0% and everything remains the same? So the cap rate value of $1 change in NOI. Take a look here. Cap rate 2%. The value is $50. The cap rate is 3%. The value is $33.33. $33.33. 4% is $25. 5%, $20. 6%, $16.67. 7% is $14.29. 8% is $12.50. 9% is $11.11, and 10% is $10. Case study. 1. Seller representative. You sold John and Hillary their home a year ago. John is partner in a litigation law firm, while Hillary is the chief accountant of a public agency. They have inherited a portfolio of commercial investment properties that is worth $30 million scattered all around the Lower Mainland in the past 2 years. Today, you receive a call from Hillary asking if you want to meet her and John to talk about listing one of their apartment buildings in the Metrotown area. They want to put the property on the open market and offer to pay a total commission of 4%. They provide you with the current balance sheet and statement of loss and deficit of the property. They have a listing price of $7,280,000 in mind. The building has a pet restriction policy and no pets have been allowed since day one. So you have the statement of loss and deficit here for the year ended December 31st, 2015. So we have the rental income, $414,670. Total revenue is the same. Expenses, let me enlarge this here. So we've got bank charges and interest, $1,023. Business license, $1,449. Depreciation, $127,833. Insurance, $10,945. Legal and accounting, $2,509. Loan interest, $158,624. Management fee, $8,763. Miscellaneous, $903. Office supplies, $0. Property taxes, $26,238. Repairs and maintenance, $44,260. Salaries and benefits, $26,441. Telephone, $919. Utilities, $70,813, waste removal $7,264, and WCB expenses $253. Total expenses $488,237. So we have another balance sheet here as of December the 31st, 2015. So the assets, we have current assets, cash, $128,637. Prepaid expenses and deposits, $17,315, which all equals $145,952. So that's what we get when we add $128,000 plus and $17,000 plus for the current assets, cash, prepaid expenses, and deposits. Then we got a property, and there's a note 1 there. We'll look at it. Should we look at it now? Note 1? Can't find it. All right, so note 1. It says land is worth $2,249,122. The building is $3,685,231. You add those two numbers together, you get $5,934,353. So you minus or you less the accumulated amortization and depreciation, which is $617,251. And that comes out to a total of, because we're minusing that from 5.9 million plus. So that comes out to $5,317,102. So other assets, we have an incorporation cost, $1,288. Total assets, $5,464,342. So liabilities, share capital and deficit. We have current liabilities, accounts payable, $288,678. We've got the payroll remittance payable, $443. Deposits received, $15,824. You add all these current liabilities together, you will get $304,945. Long-term liabilities due to shareholders, note 2, $633,982. And loan payable, note 3, we've got $5,665,582. Sorry, I'm getting this wrong here. The due to shareholders is 3.6 plus million. The loan is about 2 million. So you add those up. The loan payable is 2,381,600. 2,031,600. You add those up, it comes out to 5.6 million plus, right? 5,665,582. So we go to the share capital and deficit. Issued and fully paid 2,000 common shares at a penny each. So that's 20. And the deficit is 506,215. So that is equal to 506 or minus 506. And that deficit was like a minus, okay? So anyways, we got minus 506,185. So we've got the total liability, share capital and deficit here. It's 5,464,342. All right, and let's take a look here. Notes to the financial statements. Oh yeah, these are the notes that we had talked about before. So for the year ended December 31st, 2015, unaudited, see notice to reader. So capital assets. Capital assets are recorded at cost with depreciation and amortization provided as follows. Land, nil. Building, 4% minus diminishing balance. The above rates have been utilized to reflect the anticipated life expectancy. In the year of acquisition, only 1/2 the normal rate is applied. The following is a summary of the costs and accumulated amortization of capital assets at the balance sheet date. So if you take a look here, we've got a building with a cost of $3,685,231. Addition is 0. The rate is 6%. The accumulated depreciation here is $617,251. The 2015 net book value is $3,067,980. Go to the land. The cost is $2,249,144. Addition is 0. Rate is 0. Accumulated depreciation is 0. So the 2015 net book value is $2,249,122. So the total for the building and the land, because we're adding the building 3.6, it's almost 3.7, and the land is 2.2, and it comes out to $5,934,353. Addition 0, you don't apply the rate. So accumulated depreciation is $617,251, and the 2015 net book value is what? It is $5,317,102. All right. So 2, due to shareholders. That's another no. The amount due to shareholders are unsecured, non-interest bearing, and have no specific terms of repayment. 3, loan payable. Long-term loan payable to overseas company. The term of the loan is 10 years, commencing September 29th, 2011, and ending September 28th, 2021. Interest payable annually at the rate of 8% per annum, and with no principal repayment for the first 5 years of the term. All right. Let's shrink it a bit here. So, activity. Which listing contract fee agreement forms do you need to prepare for John and Hillary to sign? So refer to pages 6 and 7 of the workbook for assistance. 2. John and Hillary agree to sign an MLS contract with you. However, one of their neighbors, Dixon, has expressed interest in the property. They have been working on a private deal for a long time, but John is not sure if Dixon is offering top dollar for his property. John wants to make sure that this private deal with Dixon will be exempted from paying commission. What should you specify in the listing contract and also in the MLS data input form, Appendix M, page 102? So 3, based on the statement of loss and deficit on page 53, fill in the income and expenses APOD section below. APOD is found on page 3 of the commercial data input form, Appendix M, page 104. So you can see this sheet here. Complete for multifamily must be properties with 5 or more units. So building type, we've got high-rise, 5+ stories, mixed use, low-rise 2 to 4 stories, multiplex, 5-plex, mobile home park and condo strata complex. For the building details, the suite mix, we have the types and the number of units. So you would list the number of units here. So bachelor studio, 1, 2, 3, 4 bedroom, the penthouse, other, and then you put the total number of units. Income and expenses, APOD, we have the gross income, you write it there. Other, effective gross, operating expense, the net operating income, and the estimated cap rate. See Realtor remarks for relevant income and expense explanation if necessary. Based on a listing price of $7,280,000, what is the cap rate of the property? 5. If the market comparable cap rate is 4%, what is the market price of the property? 6. Identify points of interest from the balance sheet and statement of loss and deficit on pages 53 and 54. 7. Identify your seller's strengths and weaknesses from the balance sheet and statement of loss and deficit on pages 53 and 54. Case study 2, buyer representative. You sold Peter and Mary their home 2 years ago. Peter is a doctor and Mary is a dentist. They have accumulated an interest portfolio of $30 million in stocks and T-bills. One day Mary calls you to tell you that they want to invest in an apartment building to diversify their portfolio. They want you to be their realtor. You find them an apartment building in Metrotown area from the MLS. Listing brokerage is XYZ Realty. The property has an asking price of $7,280,000. Commission to the cooperating brokerage is 2% of the purchase price. The building has a pet restriction policy and no pets have been allowed since day one. The listing agent provides you with the current balance sheet and statement of loss and deficit for the property. Statement of loss and deficit. For the year ended December 31st, 2015. Revenue, rental income, $414,670, and that's the same as the total revenue. Expenses, so we've got bank charges and interest of $1,023. We've got a business license costed $1,449. Then we got the depreciation, $127,833. We've got the insurance, $10,945. Legal and accounting, $2,509. Loan interest, $158,624. Management fee, $8,763. Miscellaneous, $903. Office supply zeros. Property taxes, $26,238. Repairs and maintenance, $44,260. Salaries and benefits, $26,441. Telephone, $919. Utilities, $7,813. Waste removal, $7,264. WCB expenses, $253. And then so we add all these up, we come out to $488,237. So the balance sheet here as of December 31st, 2015. So the assets, current assets, we've got cash of $128,637. Prepaid expenses and deposits, that's $17,315. So add that 128 plus and 17 plus, and it comes out to $145,952. So we got the property. There's a note below, note 1. Land is worth $2,249,122. The building is $3,685,231. You add the land of 2.2 and the building of 3.6, you get $5.9 million. $5,934,353. So you less or minus the accumulated amortization and depreciation. So that's a minus of $617,251. And it comes out to $5.3 million basically. $5,317,102. Other assets, incorporation cost is $1,288. So you take all these assets, add them together. The total assets are $464,342. So basically it's over $5.4 million. So we've got the liabilities, the share capital and the deficit. The current liabilities, accounts payable, that comes out to $288,678. The payroll remittance payable, $443, and the deposits received, $15,824. So that all added together becomes $304,945. Long-term liabilities, we've got due to shareholders, note 2, $3,633,982. And the loan payable, note 3, $2,031,600. You add all the long-term liabilities, the due to shareholders and loan payable. 3.6 plus 2 is equal to 5.6. So 5,665,582. Then we have the share capital and deficit. So issued and fully paid 2,000 common shares at 1 cent each. So we've got 20. So the deficit is minus 506,204. And the total becomes minus 506,185. So we have the total liabilities, share capital and deficit comes out to 5,464,342. So it's basically almost 5.5 million. All right, then we got the financial statements notes for the year December 31st, 2015, unaudited. See notice to reader. Number 1, capital assets. Capital assets are recorded at cost with depreciation and amortization provided as follows. The land is nil, the building is 4% plus diminishing balance. The above rates have been utilized to reflect the anticipated life expectancy. In the year of acquisition, only 1/2 the normal rate is applied. The following is a summary of the costs and accumulated amortization of capital assets at the balance sheet date. So, we've got the building cost. 3,685,231. At 4%, the accumulated depreciation is 617,251. So the 2015 net book value is 3,067,980. The land cost 2,249,122. 0% rate. Accumulated depreciation 0. So the 2015 net book value is 2,249,122. So the total, so you add the building and the land. So the total is 5,934,353 because you're adding 3.6, almost 3.7 for the building. The land is 2.2, so you come out to around 5.9. So the total accumulated depreciation, so it's only on the building, not the land. That's 617,251. So the 2015 net book value of the building and the land, 5,317,102, because you're adding around 3 million for the building, 2.2 million for the land. So 3 plus 2.2. Here in this case, it comes out to 5.3, over 5.3. So second note, due to shareholders. The amounts due to shareholders are unsecured, non-interest bearing, and have no specific terms of repayment. 3, loan payment, long-term loan payable to overseas company. The term of the loan is 10 years, commencing September 29th, 2011, and ending September 28th, 2021. Interest payable annually at the rate of 8% per annum and with no principal repayment for the first 5 years of the term. So, case study 2 activity. Number 1, which listing contract agreement forms do you need to prepare for Peter and Mary to sign to secure your commission? 2, fill in Part B of the disclosure of remuneration form, assuming the offer price is at full price. So I, your name, am licensed under the Real Estate Services Act, and I disclose to you that my related brokerage, so you put it in, anticipates receiving a commission of, put the commission, from, put who's going to give it, with respect to real estate services provided to you or on your behalf in relation to the subject real estate. 3. In the realtor remarks of the listing, there is a clause that says seller's rights reserved. What is that? What is seller's rights reserved? 4. What is the net operating income, NOI, of the property? 5. What is the market price of the property based on the comparables cap rate of 3.3% in the area? 6. Identify points of interest from the balance sheet and statement of loss and deficit on pages 59 to 60. 7. Identify the seller's strengths and weaknesses from the balance sheet and statement of loss and deficit on pages 59 and 60. 8. This is the first time you have seen the contract of purchase and sale for commercial real estate. Appendix J, page 88. You immediately take a look at the contract of purchase and sale, Appendix K, page 95, that you are more familiar with. Compare and write down the differences between the two contracts. So we have some resources here. Realtors' own resources. The commercial broadcast email service provided by the REBGV Commercial Division, Paragon Commercial, Commercial Edge, BCREA, CREA. Government resources. We have the CMCH, BC Assessment, Cities Planning Department, the GIS, or in Surrey we have Cosmos, BC Online, MyLTSA, Federal Incorporated Company Search. And we have 3 third-party resources, RealNet, listing services like LoopNet and CoStar, and we have the Altus Group Analytics. Commercial brokerages like CBRE, Colliers, Avis Young, Cushman, and Wakefield's Research Reports. And then we have